Well, it was quite the day in the European bond market. 10-year Italian government bonds yields fell to a record low of 3.19%, and yields on 5-year Spanish debt fell below their U.S. equivalents for the first time since 2007. It wasn't that long ago that investors fretted over the possibility of the Eurozone breaking up, or some countries dropping out, or being kicked out of the common currency. That, of course, caused bond yields to go the complete other direction, sky high. So what has changed that suddenly makes some of the most beaten up debt markets of the past 5 years to be such a low-risk bet for investors? Let's get some answers from Alex Dershevsky, founder and managing partner at Recovery Partners. Good to have you back, Alex.
Thank you very much, Howard. It's nice to be here.
So what explains this? I mean, the Spanish 5-year with a yield lower than a U.S. 5-year?
Yeah, well, not only that, nothing fundamental has occurred. Recently, the ECB and the IMF estimated that there's over €1 trillion of restructuring that still has to be done to bank credit portfolios in Europe. And none of that's happened. There's been no change to the fundamentals. We've still got a sluggish growth picture that could be supporting the lower yields. But the biggest factor is that you can't underestimate greed. And that's what the EU and the ECB are appealing to in terms of the banks and investors in Europe when it comes to the domestic bond markets. A few years ago, when everything looked very dicey, it was dicey because anywhere above 5.5% to 6% in most of these yield markets means that the governments go bankrupt very quickly. They can't afford that size of an interest payment on their debt. So it was imperative for the European Central Bank to come up with a formula, a fix, to force rates down. And they've been doing that ever since. And basically they're playing, the financing game, and they're enticing people into these markets on a leveraged basis by offering very low base rates with some term premium in there. But I would argue that, rates basically have a term premium and a risk premium. I would argue that the credit risk, the default premium in the rate structure now in many European markets is totally out of whack.
So you're saying these yields are unrealistic?
Absolutely. I would like every one of us has probably watched Bugs Bunny Roadrunner, and we know when Wile E. Coyote, is trying to blow up the Roadrunner, he's got this plunger and he plunges and the dynamite doesn't go off, and then he starts bouncing up and down, and the plunger still doesn't, dynamite still doesn't go off. Well, that's Mario Draghi. The ECB is bouncing up and down on the plunger. They're trying to get the economy going, and eventually it all blows up in Wile E. Coyote's face. Well, it's the risk here.
But I had Wilbur Ross on yesterday, and one of the things he's doing right now is he's looking around for real estate in southern Europe, places like Spain, Greece, and so forth.
Wilbur's got a very good eye for value, but he's not going to be buying bonds because bonds at these levels are a one-way bet. It's very unlikely that we're going to get much more, your risk reward at these yield levels. Greek bonds, 10 years at 325, 330. Come on. There's very little prospect for these yields to go that much lower, and a whole lot more prospect for them to go back to where they were.
But is he seeing an improving economy there, and that's why he's buying? He's not buying necessarily the sovereign debt.
No, he's not.
He's buying what he thinks is an improving economy, distressed assets within an improving economy.
Well, in this type of an environment, your financing rates are very low. So on a distressed play, you're typically looking at double-digit yields in the low 20s. So from that perspective, there's a lot of risk you can carry on that type of a play relative to a bond play where you're buying, say, a 5-year at 1% or at 3.5%. It's a much different risk-reward trade-off. In the fixed income area right now, I think we're at an extreme point in terms of valuation.
A couple minutes left. Obviously, when we used to have you on a couple of years ago, we were in the midst of that crisis. Yeah. I think Greek yields might have hit 30% at one point.
Oh, absolutely.
People have made a fortune on some of these bonds. And now you've got the ECB kind of jawboning about possibly doing quantitative easing.
Yeah.
And so, if that actually comes through, then what happens?
Well, this is what I mean about jumping up and down on the plunger. They're desperately trying to keep the rate structure in place. If this thing comes unstuck, it could go back very, very quickly because there won't be much support. So what the ECB is basically saying to the market, it's again appealing to people's greed. It's saying stay in these trades. Don't cash them in. add to your positions. We're backing you up, because if rates start to rise, we're coming in with the big firepower. We're going to buy all the bonds. We're going to keep you guys whole. Just play with us and you'll be fine. And that's the real game. And the question is, when to get off the merry-go-round for most of these investors.
But so far, it seems to have worked.
It has worked in spades. It has worked in spades. I agree. I can't argue with it. I mean, it has worked, and it's because it's a financing game. You offer people the ability to borrow at lower than 0.5% and invest at 3.5% on a leveraged basis. You're going to make money for jam. That's what's been happening over the last few years. It's an appeal to people's greed.
All right. Got to go. Good to have you back.
Thank you, Howard.
Thanks a lot. Alex Jashevsky of Recovery Partners. You're watching Headline on BNN.